Today we did get some comments from Fed Kashkari that can be seen as a negative for markets, suggesting that we may get less rate cuts if the economy continues to perform well. I will share that with you here in this video, as well as what's currently going on in markets. How is sentiment positioned? Are people bullish? Are they bearish? Do I think the markets can rally further from here? Or are we about to top out at about that 6,000 level on the SPX, about 600 on the SPY, in which we are right there right now? We will also share this clip with you from CNBC's Cameron Dawson that says we cannot ignore that valuations are stretched. Things first, Fed Kashkari says that the Fed makes progress on inflation, but not yet the job is complete. He says that housing inflation will take time to decrease completely, and deficit and debt levels are up to Congress and the president to resolve, because the Fed, they do not make fiscal policy. Tax cuts that are paid for are less likely to cause inflation, and this is the big one. Fed Kashkari says the Fed may not cut rates as much if growth and productivity remain strong. I actually don't see this as a big concern from my perspective. Yes, growth looks good today as Trump begins his presidency and Elon Musk works with the Trump administration to lower costs, to cut back on certain areas within the government. You are likely going to see weaker economic data. Now, is this going to be recessionary? I have no idea. But you are likely to see some weaker economic activity. And with that will come lower inflation. And with that will come more cuts from the Fed. I actually don't think we're going to get less cuts. I think we're going to get more cuts. More cuts because of a continuing moderation in the economy, but really because inflation comes down. I think once you start to get close to that 2% target, we may actually undershoot that target. If the last Trump administration's, inflation track record is not enough, I think it should be. I think common sense really reigns supreme here. Cutting government spending, even in a moderate way, will reduce inflation. Now, some people think inflation is price gouging. Some people think inflation is people just spending all of their money and being frivolous and this and that. Milton Friedman once said, people have always spent all of their money. Corporations have always tried to have the best margins possible. The only variable that ever changes is government spending. Now, you also get demand shocks, supply shocks, those things happen like COVID when you had supply shocks and people had to buy certain things and those certain things were less available. Obviously, that's going to be inflationary. But in a normal economy like we are in today, the only variable that causes inflation is government spending. And the government is spending right now, in case you didn't know, about what they do during crises, right? Crises like COVID and World War II. Our deficits are 7, almost 8% of GDP. That is not a normal non-crisis, government spending level. And that is what has helped boost up the economy and also at the same time boost inflation. With some of that going away, not all of it, but some of it, you will likely see weaker economic activity, still good, maybe 1.3% GDP, something along those lines for 2025, in my personal opinion. But you could also see 1.5% inflation, which would prompt the Fed to cut rates more to try to get that back up to about 2%. Fed Kashkari also says that the Fed needs to continue on focusing to meet their mandates. He also says that uncertainty about the Washington dynamic with the Trump administration, and says he's really not worried about it. The goal is low inflation. Now, again, from these comments today from Kashkari, if there's one that really sticks out, it is this one. The Fed may not cut rates as much if growth and productivity remain strong. Again, I don't think that is going to happen. I don't think you're going to see the economy continue to be red hot, I think things will slow down a bit. I also think inflation will come down more than expected. So I do not agree with this standpoint of we're going to get less cuts because the economy is strong. I just don't see that. I don't see a plummeting economy either. I mean, you should see the cruise ship, just how many people are spending crazy amounts of money. I mean, yes, that's just one ship, 6,000 people or so. But if that's any accurate representation of America, I mean, it doesn't look terrible. Lower income Americans have been struggling. This is true. And maybe they can start to recover a little bit, especially if gas prices fall, if overall inflation starts to come down. With that said, take a listen to this clip from CNBC's New Edge Wealth, Cameron Dawson, that says we cannot ignore that valuations are stretched. I've talked about this before here on the channel. Valuations, at least in the short term, do not matter. People do not wake up one day and say, I should sell this stock because it's overvalued. Unless obviously the markets were to go parabolic, something euphoric that doesn't make any sense, then obviously that can happen. But that's not what happens during just a melt up or a normal kind of rally in a market.
To our talk of the tape, with an already strong bull market getting an extra kick from anticipated policy help and the Fed loosening policy into a sturdy economy, what's not to like? Let's ask Cameron Dawson, New Edge Wealth Chief Investment Officer. It's great to see you.
Good to see you.
You know, it's sort of, you line it all up like that, it looks like green lights as far as you can see. Is there anything to bring into the conversation to complicate the story?
I do think we have to respect the uptrend, which has been just so very powerful this year. And clearly through the election, we removed the tail risk of potentially higher corporate taxes and maybe higher regulation, which is certainly something that the market is celebrating. We cannot ignore that valuations are very stretched. We're at 22.5 times earnings. We also cannot ignore that earnings estimates themselves have actually been getting trimmed over the last couple of months. And so you're seeing this divergence brew where the upside in the market really driven by sentiment, driven by valuation, not necessarily because of a fundamental change in the earnings picture. So we think we have to watch that the most closely over the course of the next couple of months.
Yeah, I mean, valuation has been certainly a little bit of a shadow on the market for a while, more so now. 22.5 times, as you mentioned, it's pretty much as high as it's been since the post-pandemic boom, when earnings were probably a little more depressed. And you mentioned, 275 is where S&P earnings for next year have been cut back to a little bit. So whatever you say, it's still 21 times next year's number. I guess you would counter that by saying, in a bull market, if the stories line up, and right now you have this ability to believe that either the cycle can sustain itself for longer than we expected, or it can accelerate to a degree in a private sector friendly way. I mean, I think that seems to be the chatter.
And I do think that valuations at the end of the day need a catalyst in order to be able to be a true weight on the market. And what you typically see is that valuations start to fall when you're cutting growth estimates, when you're cutting EPS estimates, when people are getting more concerned about the outlook. So even though we're now pushing up against those 2020 highs, and to your point, those were 2020 highs based on depressed earnings and the Fed that was growing money supply at 30%. You were flooding markets with liquidity. Very different story. But until you start getting a question about growth, then we do think that valuations keep potentially drifting higher. It's why valuations are a poor timing tool. Really helpful for the 5-year, not at all helpful for 1 year.
In terms of timing, or at least tactical considerations right now, you can't really stand in the way of that kind of momentum move we saw a couple of days ago. Usually that tells you, again, as you say, the trend is pretty sturdy. But what about, expectations for whether we need to cool off a little bit?
Well, we are overbought if we look at things simple as the RSI. So it is expected or would not be too much of a surprise to see a little bit of a digestion. But to your point, you did see that breadth surge. You saw the number of 20-day highs surge to 55%. You had folks like Jeff DeGraff saying that you've effectively gotten escape velocity. These are things that you typically do not see at market tops. It does not mean that you can't digest the power of the move, mostly if we have something like a CPI that comes in a little bit hot next week, which could jostle markets, for example. So, of course, we have to keep those things in mind, but usually the track record of breadth surges is positive.
It is. It's certainly eventually positive. Almost everything, when you dial it ahead 12 months or so, it usually resolves to the up.
And I'm pretty much in perfect agreement with that clip here. That's really a lot of the same things that I have been saying for a while, that, you know, valuations, they're a really bad market timing kind of thing, that valuations can keep going higher really until something disrupts them, causes a growth concern. EPS estimates have been falling for the last 2 months now, and Wall Street has not cared, and stocks have went higher. So if that is your bear thesis, I mean, that's not a good one. Okay, we have a lot of tailwinds for us, and that has pushed markets higher in the last couple of days specifically. But if you don't get bad news, if you don't get bad data, markets are probably not going to come down. Now, if we do get bad news, like a hotter than expected CPI report in this upcoming week, then you likely do see that consolidation. As I said earlier in this video and prior videos, you will likely get some consolidation at some point. Now, question is, we are at, what are we at? 597.98 on the SPY. Almost that 600 level. Do we rocket past 600 to, let's say, 610 or 620 and then get consolidation down to 600 again? Do we get, you know, some rejection around 600, consolidate back down into the, you know, low 590s, high 580s? Those are plausible scenarios. Now, clearly, you just want to stay invested in markets. You don't necessarily want to try to time a 2%, 1% drawdown for markets. That doesn't make a whole lot of sense. Obviously, if there were to be some impending crisis, you could probably want to time that a little bit more. But I don't think that's where we're at. I think we can expect perhaps more volatility. But overall, I see way more positives than negatives at this point, especially after we do go through a little bit of a consolidation effort. Then I think we march higher into year end before we do get another, again, growth concern, growth scare at some point before mid 2025. And that's going to be your next big buying opportunity. So with that said, ladies and gentlemen, let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.